Hi, this is Anuj Jindal, and today we are going to talk about something very important, that is the new framework or new set of rules which have been released by RBI on 13th or 14th of February on NPA resolution in banks. Now, a lot of chat is going on with respect to how these frameworks are going to work for betterment of NPA resolution, and so it's important that we understand and we remember a lot of features and a lot of provisions which have been provided and which have been amended in this particular framework or set of rules which have been released by RBI. You can subscribe to my free 20-day RBI Grade B video course, which has more than 15 videos and which will give you a very good and brief idea as to how do I cover the entire course, entire syllabus. You can do that by just logging into my website www.anujindal.in and subscribing to this free video course. So let's start with our discussion on the new Charter of Rules by RBI. This video is a continuation of the video which was created on PIB and Business Newspaper for 13 to 15 February 2018, and this video has been created separately in order to ensure that you are well aware and this does not get mixed up with other videos or other news items. Now, first of all, what is the purpose of coming out with these new Charter of Rules? The main purpose was to create a harmonized and simplified generic framework. Now, the reason that this has been written here is because whatever rules and regulations and Charter of Rules and frameworks RBI had been coming out with till now had created a lot of confusion and were ineffective in reducing the number of NPAs or in plugging the hole of NPAs in India. And therefore, RBI realized that they have to come out with one comprehensive framework which is able to serve the purpose of reducing NPA number and amount of NPAs in India. So, what exactly has RBI done in order to ensure that harmonized and a simplified generic framework is created through this new Charter of Rules? Number one, definition of financial weakness has been created, and failure to recognize them will invoke special penalties on banks. So, this is the first time that something like this has been done. So, if a firm or a company is financially weak, then the banks have a responsibility to recognize them. And if they fail to do so, then special penalties will be imposed on banks. A very important provision of this is that all prior schemes, including the popular Strategic Debt Restructuring Scheme, S4A or Scheme for Sustainable Structuring of Stressed Assets, the Corporate Debt Restructuring Scheme, and Joint Lenders Forum, all these four stand withdrawn or stand discontinued. Now, I've seen in a lot of videos that people have missed out this fourth one, Joint Lenders Forum, but this as an institutional mechanism also stands discontinued with the new Charter of Rules by RBI. Banks must keep aside at least 50% in the form of provision for accounts referred to bankruptcy court. So, whatever account has been referred to bankruptcy court, bank has to provide a provision or keep a provision of at least 50% of their entire loan amount which is under consideration by the bankruptcy court. Now let's get into details and talk about all the provisions one by one according to certain classifications that we have made. These were the specific and very clearly defined rules that the RBI had created. Now we are going to talk about something more technical and something more difficult to understand. Number one, rules for early identification and reporting of stress. Now, lenders shall identify incipient stress in loan accounts immediately on default by classifying these stressed assets as SMAs as per the following categories. Now, you might get confused. In fact, I also asked the same question to myself that RBI had already done this. RBI had already classified the stressed accounts as SMA 0, 1, or 2, and the banks were required to identify them. Then, what are these new rules going to do? Why has RBI mentioned all this in its rule book that it has come out with, that it has released on this new Charter of Rules? And what is the purpose of exactly mentioning that now the lenders are supposed to identify the incipient stressed accounts immediately on default and identify or classify them as SMAs? Because RBI has already been doing it, has already released regulations and rules regarding doing this to all the banks. So, what exactly is the amendment? We are going to talk about that now. Before amendment, let's understand this very briefly. Before amendment, RBI had set up CRILC in the year 2014, and the purpose of CRILC was to collect, store, and disseminate data on all borrowers' credit exposures into special mention accounts, that is SMA 012, having aggregate fund based and non fund based exposure of rupees 50 million and above. Now, the important thing to understand here is that this is the responsibility of CRILC and not of banks. Therefore, what RBI had done, RBI had created another agency whose responsibility was to collect information, store the information, and disseminate information on borrowers' credit exposures. So it was a central repository which had access to credit exposures of all the borrowers. So it was supposed to collect, store, and disseminate data on all borrowers' credit exposures and to classify the borrowers who were not paying their loans back or who were actually defaulting on their loans and classify them as SMA 12301 or 2. And this was to be done only on exposures of rupees 50 million or above. Now, lenders were to report separately to CRILC either quarterly or for CRILC SMA 2. Now, the interesting thing is what lies here. In 2014, sorry, the RBI had said that the lenders or the banks are supposed to report to CRILC only on two occasions, either quarterly or for accounts which are to be classified as CRILC SMA2, that is exposure of 61 to 90 days, that is a default of 61 to 90 days. But now it has been changed. And what is the change? CRILC main report, that is the quarterly report, will now be required to be submitted on a monthly basis. So this is the amendment that RBI has made. Secondly, the lenders shall report to CRILC all borrower entities in default with aggregate exposure of 50 million and above on a weekly basis. Presently done internally by banks on to their own controllers. Now, what the change has been is that presently the banks or the lenders report to themselves or report internally to the departments which are responsible for finding out which are the what are the who are the borrowers who are whose exposure is more than 50 million and they are in default. But now the lenders are also required to report to CRILC on a weekly basis with respect to all the borrowers whose exposure is more than 50 million rupees and who are in default. That means whether they are in SMA 0, 1 or 2, they have now to be reported on a weekly basis to CRILC. Whereas before this change, the responsibility of CRILC was to collect information on itself by itself, and the responsibility of the lenders was to report either quarterly rather than monthly, or only to report CRILC SMA 2 accounts and not SMA 0 and 1 accounts. So, this is the major change that has actually been carried forward by RBI this year. Therefore, it's very important to understand not only to understand or not only to go through what are the changes, but also to understand and remember or to identify what was the process which was followed before this change in order to appreciate or in order to identify with the change itself so that it helps you in the interview as well. Now, the second classification is called implementation of resolution plan. According to this change, as soon as there is default in a borrower entity's account with any lender, all lenders jointly or singly shall initiate steps to cure the default. Now, the importance of this particular change lies in the fact that people like Vijay Mallya or recently Nirav Modi, what they have been doing is that they would take loan from State Bank of India first. Then, by defaulting from State Bank of India, they are not eligible for loans from State Bank of India anymore. So, they would go to any other bank like PNB and they would take loan from PNB. Then, when PNB also says that you are defaulting and therefore we cannot give you more loans, they would go to another bank, let's say Union Bank, and they will take loan from Union Bank also. So, this activity wherein a borrower is able to take loans from multiple lenders despite defaulting from one or more lenders is very dangerous for NPA resolution in India. And therefore, it has been decided that all the lenders have to initiate steps to cure the default immediately as soon as a borrower's account has a default. The next one that we have is implementation conditions for resolution plan. There have been a lot of changes in the implementation conditions of resolution plan. Let's talk about them. The rules around resolution plans have also been tightened, and processes involving restructuring or change in ownership for large accounts with loans of 100 crore or more will need independent credit evaluation. Now, what it says is that if there is an account which is in default and now it requires restructuring or change in ownership, and the value of the loan amount or the exposure is more than 100 crores, this means that there is required to be an independent credit evaluation of that restructuring or of that change in ownership if the loan amount is more than 100 crores. If the loan amount is more than 500 crores or the exposure is more than 500 crores, then you need evaluation by two such independent evaluators or independent credit evaluators. Only such resolution plans which receive a credit opinion of RP4. Now, what it means is that resolution plan has credit opinion from RP1 to RP7. RP1 is the safest and RP7 is most risky. So, if a resolution plan receives a credit opinion of RP4 or below, only then can the process be taken forward. Only then can it be considered for implementation. The fourth one that we have is called as timelines for large accounts to be referred under Insolvency and Bankruptcy Code. Now, this has also become very strict. For loans with exposure of 2000 crore or more, according to the new rules, what has been done is that banks have to start insolvency proceedings within 15 days against account for 2000 crore or more loan default if the resolution plan is not implemented within 180 days of initial occurrence of default. Default occurred today. Resolution plan was to be implemented within 180 days. It did not happen. Now the insolvency proceeding has to start within 15 days of expiry of these 180 days. And this is to ensure that the time limit for resolution plan or time limit for insolvency proceeding is not jumped or is not taken for granted by either banks or Insolvency and Bankruptcy Code or by any other judicial or any other body involved in resolution of these insolvent companies. The next is change in ownership. Now, change in ownership will happen when a creditor, change in ownership, let's assume that it happens, and a creditor is now specified as standard either under Insolvency and Bankruptcy Code or under this framework, that is the Charter of Rules, which have been released by RBI, what we are discussing. There are certain conditions if an owner is changed from defaulted or substandard or a lost asset to standard. What are the conditions? The conditions are that the new promoter shall have to acquire at least 26% of paid up equity capital of the borrower entity. Now, this is the borrower entity, it has 100% control, and now, according to the new rule, at least 26% is to be acquired by a promoter who acquires this borrower entity because it has been declared as insolvent. The new promoter shall be in control of the borrower entity as per the definition of control. So not only is it required that it shall have at least 26% paid up equity capital, it should also have control over the company. Now, as you all know, that control is acquired only when you have 51% stake in the company. But you can also have control when you have majority stake in the company. So you have 26%, but all the other owners, if there are, let's say, three other owners, or let's say five other owners, all of them have the remaining 10%, 20%. All the owners have less than 26% control in the company. And this promoter has majority stake in the company, and therefore he also has control over the operations of the company. So these are the two new conditions which have been created or provided in the new Charter of Rules. Under the framework, if ownership is to be or creditor is to be transformed from a lost asset to or substandard to standard category. A non-exhaustive indicative list of signs of financial difficulty has also been provided. Now it's important to remember that this is non-exhaustive in nature and therefore this is only provided in order to give an idea as to what are the signs which show that there is financial difficulty in an enterprise. Number one, irregularities in cash credit or overdraft accounts. So, if you have taken certain loan from the company for working capital and there are certain irregularities in that overdraft account, such as inability to maintain stipulated margin basis or drawing exceeding sanction limits. This is what happened in Nirav Modi case as well. He took working capital loan from a bank branch and he kept taking loans despite the fact that he was not able to pay the principal amount on the loan that he had taken for working capital. Failure or anticipated failure to make timely payment of installments of principal and interest on term loans. Delay in meeting commitments towards payment of installments due. Crystallized liabilities under LC or BGs, not very important. Excessive leverage. This means that the company has borrowed a lot if it has a total capital of, let's say, 100 crores. Against this, it has borrowed 300 crores from the market. So the leverage in the company is much more when compared with the capital. Inability to adhere to financial loan covenants. Failure to pay statutory liabilities, non-payment of bills to operational creditors, etc. So when you're not able to pay even your operational bills or the statutory or the tax liabilities that you're supposed to pay to the government, then also it means you are in financial difficulty. Non-submission of undue or undue delay in submission or submission of incorrect stock statements and other control statements. So you're not able to submit your control statements or stock statements also, which means that there is some problem with the company. Steep decline in production figures, downward trends in sales and fall in profits, margin erosion, etc. All these are signs that the company is not doing well. Working capital cycle is long, which means that you are paying a lot of money out of your pocket in order to keep the cycle running or in order to keep the factory running, but you are not able to receive from the buyers that you are selling to, and therefore the working capital cycle is very elongated. Excessive inventory buildup. This means that you are building or you are producing goods, but you are not able to sell them. Delay in project implementation, especially infrastructure projects. Downward migration of internal or external ratings. So if your ratings are going down, that also means you are in financial difficulty. So these are the major signs of financial difficulty, and in the examination a question can be framed wherein any one of them or multiple out of these can be given, and you could be asked whether any of these are signs of difficulty, financial difficulty for a company or not. So it could be a generic question. Let us now take some questions on the previous video that was on PIB and business newspaper for 13th to 15th February, and some questions also related to what we've just understood. The first question is, what is the total value of loan agreement signed with New Development Bank for Rajasthan water sector restructuring project for desert areas? As I said, the answer is 345 million. So first, such factual questions can also be asked in the examination, and you can go wrong because although New Development Bank has given 100 million right now, the value of the entire project signed between India and New Development Bank is $345 million. The next question is also very factual. It says India stands at what rank as a consumer of energy in the world? The answer is third. Now these are factual questions which have been asked in phase 1 as well as ESI phase 2 of the examination, and therefore it's very important that you are able to remember all these facts. An acronym based question, what does CAMPA stand for? CAMPA stands for Compensatory Afforestation, Fund Management and Planning Authority. So the answer is A. The next question is, as per new Charter of Rules for recognizing default loans released by RBI, the following schemes on NPA resolution now stand withdrawn except, or which one has not been withdrawn and which are the ones which have been withdrawn. Strategic Debt Restructuring Scheme has been withdrawn. Scheme for Sustainable Structuring of Stressed Assets, yes, withdrawn. Corporate Debt Restructuring Scheme, withdrawn. Joint Lenders Forum. Now, a lot of places people are missing this out, but this has also been discontinued, and therefore our answer is E, Insolvency and Bankruptcy Board, which has not been withdrawn. The next question is, consider the following statements concerning recent rules and framework by RBI on NPA resolution and identify the incorrect statement and not the correct one. Let's go through all these statements. Restructuring or change in ownership for large accounts with loans of rupees 100 crore or more will need independent credit evaluation. Yes, it is correct. With loans of 500 crore or more will need two independent credit evaluations. Yes, this is also correct. Banks have to start insolvency proceedings within 15 days against accounts with 2000 crore or more default if the resolution plan is not implemented within 180 days. This is also correct. In case of change of ownership, the new promoter shall have acquired at least 26% of paid up capital and also have control over the company. This is also correct. The last one is banks must keep aside at least 60 to 70% in the form of provision of accounts referred to bankruptcy code. The answer here is 50%. Banks have to keep aside a minimum of 50% in the form of provisions for the accounts which are referred to bankruptcy code through Insolvency and Bankruptcy Board of India. And therefore our answer is E. Let's now very briefly talk about impacts of the new framework. There are going to be two major impacts. The new framework will encourage early recognition, justification, restructuring, resolution, and recovery of the non-performing assets. So the purpose is to recognize, justify, restructure, resolve, and recover all these NPAs as early as possible. The message which has been provided by RBI is that if banks are adequately capitalized now, because of the capitalization done by the government recently, let them clean their books using this money rather than using this money for evergreening. So they should not be using this new money that they've received for restructuring the loans that they already have or for evergreening, because that is not going to solve the problem. What is going to solve the problem is to clean their books by closing down these NPAs and by pushing them off from their balance sheets completely. If you like my lecture, please subscribe to my channel. You can also join my Telegram group as well as my Telegram channel for regular discussions, and the link for them is available in the description section below.